Welcome, my friend, to this part 2 on day trading for beginners. So today we're going to talk about the top 3 questions that I get regarding day trading basics for beginners. We're going to explain them, help you to learn some day trading techniques here that people ask me all the time. So these are the top 3 questions that I get. Number 1, can you day trade and still work a full-time job? And the answer is yep. You sure can. So here's a couple of ways that you can do that. Number 1, you could trade pre-market. So before the market opens, then you can trade the pre-market. Now you would want to trade a market that has high volume, obviously, before the market opens. Something like the E-minis. They start trading early, or the Euro futures. They start trading really early, usually California time, around 5 o'clock or so, 5:30. So it's possible that you could actually start to trade these markets before the what used to be called open outcry back in the days when we had pits for everything. But again, you want to make sure that you're trading markets that have a lot of activity during the pre-market. So you can trade before or after. Now you could even trade during market hours if your time zone and your work hours make that possible. So for example, I'm in California. So the futures, well, even New York opens at 6:30 here. That's 9:30 New York time. So it just happens that my time zone, let's say I don't have a job, but if I did and I started work at 9, maybe I'd have to leave at 8:30, I could trade from 6:30 to 8. And that's an hour and a half. Now, you might think that, oh, but that's not enough time. I can't trade the whole 6.5 hour New York session or Chicago session. It doesn't matter. A lot of professional traders I know only trade an hour, 2 hours, 3 hours a day. And you can make a good living doing that. So don't think you have to trade the whole day. You absolutely do not. You can still day trade for an hour or two. And again, if your time zone, your work hours accommodate that, then that would be another possibility for you even during regular market hours, not having to deal with pre-market. And then finally, if neither one of those options work for you, then you can trade spot Forex. And the concept here is to trade the markets where the sun is shining. So the Forex markets, foreign exchange, currencies, they trade 24 hours a day. So you will want to trade a currency pair that relates to a country where the sun is shining, where it's going to be most active. So even though the Forex pairs trade 24 hours a day, they're not as active during some times of the day as other times. And that's very important as that you trade when they are the most active. And so basically when the sun is shining over the country where that currency is from, that's basically the concept as to when you should be trading that currency pair. Okay, number 2, second question is, should you use pre- and post-market data on a chart? So the answer is basically yes, I like to do that. Now, there's a couple of qualifications here again, certain considerations. If the pre- and post-market data has a lot of activity, like the E-minis do, then absolutely I would definitely do that. A lot of stocks don't. And so if you're trading equities, then you want to be very careful with that. Now, if you do put pre- and post-market data on there and you're trading things like futures and so forth, you're not going to see gaps. And gaps can be very, very telling. Gaps can be very helpful to see. So you may want to use 2 charts and just have a separate chart up there that does not show pre- and post-market data, so you can still see where those gaps are. And even if you're not trading that particular chart, just want to see where they are, and then you can draw those lines where the gap opened and then where it closed or whatever. In other words, where it closed one day and opened the next day, and draw those lines on the chart that you are trading, because those gaps are very, very important. People are looking at those. Another option that I really like is to use pre- and post-market data, but use tick bars instead of time-based bars. If you use time-based bars and you're trading especially a lot of stocks which don't have a lot of activity pre- and post-market, then you're just going to see price patterns that don't really make a lot of sense, candlesticks that aren't very meaningful. You're going to see a lot of little mini gaps, and because there's not a lot of volume traded, and technically it's not very meaningful. So if you use tick bars, then that smooths out the price action. Because each bar isn't represented by a certain period of time, it's represented by a certain number of trades, and therefore you get more meaningful price action for your technical analysis. All right, and finally, question number 3. Oh boy, I get this one all the time. What's the best time interval for day trading? Now, there is no one best time interval with regard to making money for day trading. But there are some factors that you need to consider, and they are very, very important. So, the assumption, I think, a lot of times is that, there's one time interval that's best for some markets or for some exchanges or for certain trading patterns. Not necessarily true. Here are the things that really are important for determining the best time interval for your trading. Number 1, the size of your trading account. Now, the reason that this is so important is for money management purposes. You've got to look at the size of your trading account and then say, okay, I can only risk so much money per trade, or so large a percentage of my account per trade. And therefore, when you get a shorter time interval, your bar ranges are going to be more narrow, they're going to be shorter, and therefore at the swing highs and swing lows, you'll be risking less money, less dollars. And therefore, if you have a really small trading account, you're probably going to have to trade faster time frames just for pure money management reasons. Because we don't want to, my rule is not to trade more than 2% of my entire trading account on any one given trade. And that is based on where I enter the trade to where I place my protective stop. I don't want that to be more than 2%. Actually, personally, I don't like to be more than 1/2 of 1%. But I would say 2% should be the maximum for anybody. So that is a huge thing. You start there, because money management and risk management is more important than anything else. Now, the other thing that you have to take into consideration is whatever market you're trading. What is that market's average daily volume? So a stock or a futures market that has very little volume, first of all, I might not even trade it at all. But if it's a lower volume market, then I'm going to probably trade a time frame that's more appropriate for it. And when that's a more, for example, I'll just give you a couple of real life examples here. So for the E-minis, personally, I like to trade a 1,000-tick chart on the E-minis. But when it comes to something like the yen futures, I only trade a 100-tick chart. Why the difference? Because the yen has much less volume traded than the E-minis. And that's how I personally adjust. I'm not necessarily recommending those timeframes for you, but those are the ones that I use, and that is based on average daily volume. It gives more meaningful patterns. Now, the other thing, and the final thing that we'll talk about today, is your own psychological aspects of what you need. In other words, how much time do you need to analyze a setup and really look at it and then trade it with confidence. This is going to be different for each person. I can't tell you what that's going to be. It's only a gift you can give yourself through some experimentation. Get on a simulator or a demo account. Try a couple different time frames that meet number 1 and 2 there, your trading account side, the market's average daily volume, so it's giving some meaningful price patterns. And then just start trading it on a simulator and see, hey, is this moving too fast for me? Where I'm not able to have enough time to really analyze the setup and trade it with confidence. If it's moving too fast, then you have to go to a slower time interval. If it's going too slow for you, well, then just the opposite. You can go to a faster time interval. So that's the third element. So there you go. Those are the top 3 questions that I get from day trading beginners. And hopefully you found that helpful. Feel free to send me an email at barry@topdogtrading.com or put a comment down below if you have any questions about this. Be very happy to answer them. And hey, give it a thumbs up, a like, share this video with other people. It's always good to share good things with good people. And finally, I have a special offer for you where I am giving away my rubber band trade. This is a complete trade setup, and I will show you exactly where I get in, exactly where I get out, all the details of the trade setup. And my intention is that you can start making some money with it right away. Give it to you absolutely free. Just click on that cute little green box in the top right corner of the video there, and that'll take you to a page where you can register and get it No charge, no credit card, no nothing. Just go get it. My compliments to you.